What's up, guys? Today we're talking about how to make a profit yield farming without having to time the market. I will share with you guys the main strategy behind where I'm making a lot of profits from yield farming concentrated liquidity pools. You guys can see here, even with Ethereum strength, my portfolio is doing quite well, still sitting at 6.24 ETH worth of profit. And mainly it's through applying this strategy that I will be sharing with you guys in this video. So if you're interested in yield farming and how to make more consistent profits, then be sure to watch the whole video. If you guys are new here, my name is Richard. I'm a yield farmer and investor, and hopefully this channel helps you become a better investor and yield farmer. So let's dive right in here. And again, like always, this is not financial advice. Please do your own research. I'm not your financial advisor. I'm just some guy on the internet, so keep that in mind. So before we actually go into the tactics, we gotta look at this selection criteria. When we're trying to look for new pools or which tokens we want to yield farm with, typically I like to look at these things. The first thing is the fundamentals. Stuff like the actual metrics behind the project, right? The total value locked, if it's a DeFi project, or stuff like transactions, revenue, volume, social interest, and if people are talking about that project. Those are all fundamentals that we need to consider, as well as the market fundamentals. And the technical analysis, in my opinion, is very important because a lot of investors and traders do make decisions based on technical analysis combined with fundamentals, and it becomes like a self-fulfilling prophecy, right? If people are selling at resistances, then those areas will likely stay as resistance, right? And if people are buying at a certain price level, those areas are typically great areas to buy, and it would turn into a support zone. And lastly, we want to look at narrative as well. For example, something that is more hot recently is the stablecoin narrative and real-world assets, because more and more companies are putting stablecoins on chain. Stuff like Syrup, Maple Finance, Athena with the ENA token. You can see really strong price action here in the last few weeks. So we do want to have a narrative that we can bet on. And the hottest narrative might change all the time. Last year, it was mainly AI and meme coins. Maybe this year would be different, right? So we want to look out for like potential narrative that we could position ourselves in so that we could make massive gains in the market. And these three applies for major assets as well. For example, Ethereum last year didn't really have that strong of a narrative compared to Solana. But now Ethereum has been outperforming Solana because of the ETF inflow, institutional interest, and the stablecoin narrative just makes Ethereum a really strong chart, right? If we look at Solana here, it's not as strong as Ethereum. In the last couple of months, you can see the strong downtrend on Sol to ETH that it has not been able to reverse yet. The second thing we want to think about is that we're providing liquidity that we're comfortable holding for 6 to 12 months at the very minimum, and ideally for years. This strategy is a longer term strategy. We're not trying to day trade here. We're trying to maximize our profits by accumulating these assets at a good price and then de-risk ourselves when the prices are higher and higher. And the reason why I like a longer time horizon is because sometimes negative catalysts just come out of nowhere, right? A lot of people didn't see like the Trump tariff dump that came this year. If we look at Ethereum's price here, it dumped pretty aggressively from 4,000 to below 1,500, right? If you were a shorter term trader or investor, you might have panicked and sold all of your holdings. But if you're applying the strategy that I'm showing you in this video, you would have been able to make a ton of profits on the way down and then on the way back up, where the price is now near the $4,000 mark. So 6 to 12 months at the very minimum if we're yield farming for most pairs. And this doesn't mean that we're going to be in range for 6 to 12 months at a time. We want to be prepared for it. But if a good profit-taking opportunity comes, we do want to take our profits and then think about reallocating our capital somewhere else. And the third thing is we want to look for a pair that is moving sideways, like a crab, or on an uptrend that is still not overdrawn yet. And let me show you guys a few examples here. For example, Ethereum is on a strong uptrend here. If we look at the monthly chart for Ethereum, is Ethereum's uptrend overdrawn on the monthly time frame? I don't think so, You can see the MACD is still not crossing yet. It's not overbought. The RSI is not overbought compared to previous cycles. And there's a lot of fundamentals behind it. So I do expect further upside based on these technicals and the fundamentals as well as the narratives, unless we see some really big negative catalyst. So Ethereum has been moving like kind of sideways in this channel for a while, but potentially it's going to go on a big uptrend here, right? So Ethereum and USDC is a pretty good chart to be providing liquidity for. I currently am in that pair as well. But if we're looking at something like Sol to Ethereum, if we drop back down to the weekly chart here, when the uptrend of Solana started in September 2023, if your goal was to accumulate Ethereum, it was actually the best time to provide liquidity, right? Because if we enter here, set a wide range, you will see a lot of capital appreciation because whatever Solana you put at the top of the range here is getting slowly sold to Ethereum over time at a higher price than your original entry, and then you would have made a ton of profits in Ethereum terms as the uptrend sustains. But a lot of times, if the uptrend is very overdrawn, like what we're seeing here, the uptrend lasted roughly about 600 days here before it started breaking down to the downside. So will this trend reverse? I'm not quite sure, but it's definitely riskier to start providing liquidity here than at the beginning of the uptrend, right? Either here or if you're entering near here on a drawdown, even if you got in at a bad entry here, if you have a longer term outlook and apply the strategies that I will be showing you guys, you're still likely going to be closing at a net Ethereum profit. So these are the charts that we want to look for. And one of my favorite chart patterns is something that just moves sideways against Ethereum. This is on the log scale. If I drop it back down, I'm currently yield farming Pendle and Ethereum as well. You can see this green line is my entry. So it's not the perfect entry. The prices are still drifting down a little bit, but this means that Pendle is cheap against Ethereum, right? So I'm happy to buy some Pendle with my Ethereum here. And you can see this is a crabbing chart. If we could get in at a good entry here, either near here, or if you want to wait for the absolute bottom, you could try to get in here as well, right? But I chose to enter here because like the distance between this mark and this mark is not that much. And I'm happy to buy Pendle at like this price or even lower at down here because I believe in this project and I'm comfortable accumulating Pendle and Ethereum. But the reason why we want to look for these charts is if we look at the historical price action, it has actually been able to retain its value against Ethereum and also outperform Ethereum in certain market conditions. You can see if Pendle outperforms Ethereum once again, I could choose to secure my profits in this zone of resistance, right? So that's why we want to like bet on like a crabbing chart like this. And more recently, I entered into a syrup to Ethereum pool. You can see syrup was on a large uptrend against Ethereum. I saw this huge pullback here. It bounced off of this 200-day simple moving average. I think the narrative and the fundamentals are strong. That's why I entered back here. We'll see how it goes, right? But this chart has a much higher chance of success compared to something that bleeds out. What we want to try to avoid here is, let's say, for example, last year before I know this concept, I was providing liquidity for a token called Magic. I'm betting on the gaming narrative, but because the gaming narrative didn't really take off last year, you can see Magic compared to Ethereum just keeps bleeding out against Ethereum, right? Of course, you can try to bet on a reversal, but if the reversal doesn't sustain, your pool is just going to bleed out in terms of Ethereum. And a lot of times, if you guys make a lot of Ethereum losses with your pools, you might as well just be holding Ethereum in the first place, right? Let's say you have 10 Ethereum, and then when you're yield farming, you keep dropping to like 9 Ethereum, 8 Ethereum, or even 5 Ethereum. Then you might as well just hold your Ethereum and then sell some of your Ethereum when the prices are high, right? So when we take more risk, we typically want to aim for more reward here, which is the next criteria here. Is the APR high enough and is the potential upside high enough for the risk we're taking? If you're yield farming a small cap altcoin with tight ranges and the pool is only pulling like 30% APR, then it's not really worth the risk. We want to aim for solid assets that have the chance of outperforming other assets, including Ethereum, so that we could gain more and more Ethereum and make the US dollar profit as the prices trend upward so that we can maximize our upside, right? If the risk is not good enough, then we don't want to enter into the pool. For example, if we look at the SOL to ETH chart here, I actually was yield farming this pair. I entered here at 0.06 and then I saw the price going upwards. I made a lot of fees and then I exited here near 0.06 again because it looks like the chart has the potential of breaking down. And surely enough, it did broke down a little bit. So I closed at a profit. But the main idea I want to talk about is if we enter here at the top of the range, the risk and the reward that we're getting is not going to be as good as if we entered back down here, right? For example, one of the more profitable pools that I'm currently in is the Bonk to Ethereum pool. If we look at Bonk to ETH here, I actually entered this pair near this zone of support here at roughly 0.0006. And you can see the price history, right? The prices just moves up and down over time. It's crabbing sideways most of the time. So there are multiple opportunities to exit the pool for a profit if I want to. And if I just want to keep earning the fees, I can as well. But the idea here is entering down here has much more like upside potential compared to entering down here, right? So that's really important to consider. We want to look at the risk and reward when we're entering into a pool and make sure that it's enough for the risk that you're taking. And lastly, we want to bet on assets with staying power. This is kind of the same as like the first 2 points. An asset that has staying power is likely going to be around for the next 6 to 12 months or longer. Stuff like Bonk, I don't think Bonk is going to be going around anytime soon. It's a very solid project in my opinion, but you guys should be doing your own research and making your own decisions. Stuff like Ethereum, just like Bitcoin, is going to be around for the next decade or so, in my opinion. Solana, even though it has been a little bit weaker, I still do think Solana is a good project to bet on as well. That's why I'm yield farming Bonk. Bonk has been one of the best bets in the Solana ecosystem, so that's my exposure there to Solana. And even meme coins like MOG, in my opinion, has a lot of staying power. The meme is still here, it's not dying off. People like buying this token, and this is exactly what we want. Let's compare that with something like WIF. A lot of times, if the chart is really weak, like WIF here, even if you have the best strategies, a lot of times you are still going to lose money if you didn't take profits last year, right? So we want to try our best to bet on projects that have staying power. It's not just going to come and go in like the next few months. And depending on the risk you're taking, we do need to adapt our strategies a little bit. So now that you know the selection criteria, let's look at the strategy here. The first component of the strategy is we're setting a wide range. I really like wide range LPs because we could still earn really good fees while having the most asset appreciation. And we also have the least amount of risk when it comes to providing liquidity. If you guys don't know, tight range LPs actually have a lot of risk when it comes to drawdowns. For example, a lot of people were yield farming Ethereum to USDC pair from, let's say, 4,500 to 3,500. That is their range there. And if the prices drop aggressively, like what we saw a few months ago, your pool is going to be pretty rapidly converted to Ethereum, right? And then you're going to suffer a huge drawdown here after the 3,500 mark. If that was your lower range, all the way down to $1,500, right? So your LP value would drop by more than 50%. And it doesn't matter if it's a crypto to crypto pair or crypto to stable pair. From my experience, wide range strategy outperform tight range strategies like more than 80% of the time. So this is why I prefer setting a wide range. We want to try to get the best entry we can. It's not a big deal if it's on a blue chip asset that we want to accumulate. We want to compound when prices are cheap, and this is going to drag down our entry. I will show you guys in a little bit here. We can de-risk and sell fees when prices are high. This lowers your cost basis and your risk, and then we can always redeploy our capital when the prices are cheap once again, right? So if we apply the strategy, we actually do not need to time the market. A lot of this is a adaptive strategy, meaning that if the prices go down, we compound, right? We sell more and more of our fees, And we don't have to do like 100% compounding or 100% selling too. You could do like an 80-20 approach or whatever ratio you choose. For example, prices are cheap, we compound 80%, we sell 20%. Prices are high, we sell 80%, we compound only 20%, right? If I had actually known this last year, I would have made so much more money and retained so much more profits if I just stuck with this strategy. But now we could consider exiting completely when the market is euphoric, either into major coins like Ethereum and Bitcoin or into stable coins. We can exit at zones of resistance as well and topping signals. So these are the things to consider when running the strategy. And I will show you guys here on the Ethereum chart. So the first step is to set a wide range, right? I personally like to look at long-term charts here, either the weekly or the monthly chart. So let's say this is the Ethereum range that I want to go with. So if I'm bullish on Ethereum, but maybe I want to prioritize the fees a little bit, my ranges are not going to be as wide as a capital appreciation strategy, right? So maybe my bottom range would be around this key moving averages here. You can see a lot of times this 200-week simple moving average provides support for Ethereum. Sometimes it cracks down, but it always goes back up above that. So maybe that's our bottom range there. If we want to be a little bit tighter, we could always be a little bit more conservative. Let's say we move it down to $2,000 on the bottom range. And then depending on what I'm deploying, if I don't want to sell a lot of Ethereum and I'm holding Ethereum, I don't want to set the upper range too tight, right? Maybe I would set the upper range at 15K if I want more capital gains. My current range is all the way at 100K because I'm trying to sell my Ethereum slowly into the pump and I want to capture the range for the next 6 to 12 months. Maybe I would set it at around 10 to 12K here. You can see sometimes like in the last bull market, Ethereum's price actually is able to move up pretty aggressively. So I don't want to miss the bulk of the move by setting my ranges too tight, right? So let's just say we enter here and the prices move upwards, right? What am I going to do? I'm going to sell most of my fees, de-risk, maybe compound a little bit if I still want to like earn more income. And if we're compounding at a higher price, it's going to move my entry up a little bit, right? But let's say Ethereum cracks down to this trend line support here, maybe around $2,000 all the way down there. I would be compounding my fees more aggressively. And what that's going to do is drag down my original entry lower and lower because we're essentially adding our capital into the pool, buying more Ethereum on the way down, right? And then when the prices are above again, I'm sitting in US dollar profit once again. And then over time, it's just going to allow me to drag my entry like lower and lower. And then I will always be in a profit, right? Especially if you guys completely de-risk out of the pools. And this is especially true for altcoin pairs. So let's take a look at that. So let's try this example here with Pendle and Ethereum. And let's say we look at the weekly chart and this is the ranges that we're comfortable with, right? 0.003 on the upper side and 0.0007 on the bottom side. And let's just say you get like an average level of entry, even though we want to try the best to get a good entry, right? So if we enter back in July of 2024, for example, when the prices are cheap, what are we going to do? We're going to compound more of our fees. So this again would drag down our entry a little bit. And then when the prices rip higher again, we could sell most of our fees or exit our position completely for a profit. But let's say we didn't exit that pool completely, right? We sell most of our fees in these couple of months here into either Ethereum or stablecoins. But if we're yield farming Ethereum, typically I like to sell into Ethereum, especially when Ethereum price is cheap. And then when the price swings back down again, what are we going to do? We're going to compound more of our fees once again, right? It's going to drag down our entry. When prices are above, what are we going to do? Sell most of our fees and then completely exit the position if we want to. And then when the prices dip below, we compound our fees once again. So that's the main idea of the strategy here. Again, it works really well because it drags down your average entry. That's the first thing, right? The second thing, it takes a lot of risk off the table when prices are trading above your entry. For example, if you guys look at my bonk pool here, it's sitting in really nice divergence loss profit, meaning that the prices are above my entry. because I compound when the prices are cheap. I deposit it here, compound once when the prices are cheap, and then every time I'm collecting my fees, if the prices are above my entry, I'm actually selling most of the profits. And that's where I lock in a ton of profits here. If we look at the log a few days ago, I locked in 0.69 Ethereum worth of profit just by collecting and selling my fees, right? And over time, this is going to give us a better chance of making a profit and also significantly de-risking our positions because we're selling when the prices are high. If the prices are low and we want to add to our positions, we compound our fees. Very simple, but I don't see a lot of people talking about it. That's why I'm sharing it with you guys. But of course, there are limitations to every single strategy. The first is if the token never recovers, you will still lose money. So if you're compounding your fees into like very small cap tokens that are just not going to recover, it might be a meme coin that has like no fundamentals and no solid community, right? Your token is going to zero. Your LP is going to trend down to zero as well. It doesn't matter which strategy you apply. If the tokens you pick to provide liquidity for drops by 90 to 99% and never recovers, chances are you're going to lose money, right? Again, no strategy is perfect. That's why we diversify and hedge. If you guys look at my current LPs here, I'm not going all in even if I'm bullish on a project, right? Ethereum to USDC, Pixel, I have a heavier allocation because I'm very bullish on the project. But at the same time, my cost basis is much lower than a lot of people. So it's fine to have a larger allocation. You can see Bonk is at a heavier allocation already, roughly like 12% of my portfolio. So I'm not going to compound too much into this pool very aggressively, right? I'm selling the fees of this pool most of the time, but positions like Pendle, I'm comfortable with like 5 to 10% of my portfolio. So I would compound this pool here. Stuff like Syrup and ETH, it's only at 6K, so I could definitely compound and add to my positions here. But the idea here is I have a mix of assets, right? Even if one pool doesn't do well, I would be fine as long as my gains outweigh the losses. This is especially true if you guys are yield farming smaller cap altcoins. We never want to go all in. We want to diversify, hedge our bets, and be more aggressive when it comes to taking profits, especially for riskier altcoins. And again, the entries and exits are never going to be perfect. This is why we have this strategy. We don't need to time the market perfectly. I just showed you guys what to do if the prices drop and what to do when the prices go up aggressively. This is this last component here. We want to consider exiting completely when the market is really euphoric. There's a lot of greed in the market. We're trading at zones of resistance. There's topping signals that are indicating these are really good times to exit the pools. So I hope that was helpful, guys. Yield farming has made me quite a lot of profits. I've been able to grow my portfolio from like a mid 5 figures portfolio to a multiple 6 figures portfolio just by yield farming. But I could have made a ton more if I just knew these concepts, right? That's why I have this channel. So be sure to check out the other videos if you guys are interested in learning more about yield farming and how to make profits consistently. Thanks once again for watching. I'll catch you guys next time.